Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Monday, November 27th. Hope you guys had a great long weekend here, Thanksgiving weekend here. Wonderful weekend here, I think. So let's jump right into it, get back into the swing of things here. We'll start off with the economic calendar. We had the new home sales for the month of October. This week we do got a lot of data coming out. Today's, we got the new home sales, but later this week you'll see kind of a variety of data from housing to like GDP will be coming out and stuff like that. You'll kind of see. So today happens to be new home sales. So as you can see here in the month of September, we had 645,000 new home sales for the year to date. It was supposed to dip down to 620,000, and it came in at 685,000. So a pretty big difference there. A pretty big jump from. Going from 645 685, obviously much better than the 620. So better beat the expectations there. Let's take a look here at the headline news. Stock market's a little mixed. The stock market, it came in this morning unchanged, and then the market was up. Since then, in the morning here, it's the Nasdaq and S&P's went to negative. Dow has lost most of its gains. It's since I've created this, it was in positive, but it's kind of dipped in negative and back into positive. So it's kind of just borderline right now as we go in. Now, a lot of it was taking its cue from retail. Retail was kind of helping it. Energy is kind of bringing it down because they're looking at OPEC coming up with a meeting later on, hoping that they continue the production cuts. But retail, of course, we had Black Friday on Friday, and it did very well. And then today we have Cyber Monday. Now back in the market this week, we got Congress is back from their holiday break, and they are working on the tax plan and hopefully hoping to have something out this week, at least some type of agreement between the Senate and the House agreement, so we can get this passed before year end here. And this is one of the reasons, of course, when the stock market's been up all week, because they've been or up all year for that matter. Because they hope for the new tax plan and creating some reprieve to the corporations. So if they don't get that, of course, you'll probably see a pretty big correction in the stock market as it was, as instead of being based on facts, it was based on optimism for this tax plan. So let's go ahead and take a look here at the bond market, see how that's playing out. Oops, sorry about that, wrong way. Bond market, here we are again. As you saw, Wednesday we had a great day. Friday it dipped a little bit. Of course, we were here with it was a short day for the market, and it was pretty much day traders that were kind of dictating it. So it did dip a little bit, but we did stop and hold right at the 200-day moving average. Today we're up a little bit. We're up currently about about 5 or 6 basis points from where we left off. It's a very slim because looked like we were going to be kind of stuck in this range from this Fibonacci number and this 200-day moving average. And since it looks like we have gone up slightly, so if we can keep above this 200-day moving average, this could be a good thing, obviously a good thing for us, and swing up there. So speaking of such, we'll take a look here. The better one is if we can get the Treasury down below this 200-day moving average. Now, this has been a tough floor support for them. Right now, they are approaching the 50-day moving average. Hopefully, we can get them to close below that and then keep knocking it down below the 200-day moving average. But again, this is all going to be dependent on a lot of different factors. Earlier today, we had a Treasury sale. We had the 2 years. I think it was about $24 billion worth, and then come in very well. And later on, we got the 5-year coming in, and we'll have to see how that translates. The auctions, Treasury was selling these. It didn't come in too well. So this is kind of one reasons why this is down a bit. We were at about 2.34, and now we're down to about 2.33 range, and see if this can dip a little bit further or not. But again, we want to try to get this below the 2.3, or this below this 200-day moving average for us to see any real sufficient move in the interest rates. Because once it goes below that, we can hopefully get it down closer to the 2% range and see some more of effect, more much improved in interest rates, so to speak. So again, as you can see, the last time we saw that was back in September, and since then it's been kind of rising. As economy, it looks like it's been picking up, and more comfort with the economy and with the tax plan and everything else talking. This is what's kind of helping the stock market, and it's helping out yields as a result. And with the Fed raising rates, this is kind of raising it, and this is where the concern comes in with the long-term interest rates kind of sitting still and keeping low because there's no inflation, and then you got short-term rates rising. Is kind of at some point look like it could create a what they call inverted curve. So we'll have a flat curve, then become an inverted curve, which basically translates to lenders or investors not lending money and having credit freezes out there, and then basically forcing us into recession. So now some of the things that came out in the Fed that their concern is the low inflation, that they may have different views in raising rates coming into 2018. Now they're forecasted to have three more hikes. We're expected 100% this month or in December here, but three more hikes in 18. But you may see some pauses. Some of them are a little hesitant because of where things are moving towards. That inflation's still low. Again, we're starting to hit a inverted yield curve if it keeps going at this pace, and by mid-year or towards late second half of the year, you could see that inverted curve, which could force us into a recession. All right, so something's got to give there. In other words, all right, so that pretty much wraps it up. Our rates are about the same. They're not going to be a whole lot difference because you're only talking about 6 basis points from where we left off on Friday. Actually, it might be a little bit worse because of the most lenders were closed on Friday, so they're going to be basically taking their numbers from Wednesday's numbers. So they're probably a little bit worse today as a result. So sorry about that. Again, most lenders were closed on Friday, making it a long weekend, and which is the reason why we didn't do this video on Friday. But if you guys want to get more data, just come over to Twitter. You can find me on my handle at Mike Bjork, and hope you guys enjoy the rest of your day, and look forward to see you guys tomorrow. Thanks again for watching. Bye-bye.